Okay, I have thought long and hard about this set of slides and what I'm trying to convey here. And there are two distinctions I want to get really clear in these videos. One is DCF and multiples are not mutually exclusive. They are connected. Multiples are a derivation of DCF on a fundamental basis. But also, I want to make it really clear that you've got to be very, very sure of what lens you're looking through. Are you trying to value an asset or are you trying to price it? And that is something that sometimes gets a little bit kind of confused in the rush of trying to execute our work. We might think we're valuing an asset, but in fact, actually, you're pricing it, and price and value are two very different things. Price is what the market thinks the asset's worth. Value is what you think the asset's worth. And you need these two lenses in order to establish whether you're going to go long the asset or short the asset, because there's a disconnect between price and value. Now, what I'm going to knock up here for you is just the way my mind works when we look at building a discounted cash flow. Because ultimately what I'm doing here is I'm picking up my history. I'm using that history to portray a sense of what I think the future holds. Now, I have George Box's quote ringing in my head all the time, which is, all models are wrong, but some are useful. My ability to forecast as a human being isn't really that great. And if I think I know what the future holds, I think I'm misdirected. And the whole point of having these models is not to predict the future, but it's to ask questions of what the future holds. So these cash flow forecasts are really thinking about the scenarios that could be presented. Now, these cash flow forecasts are going into the future. There's a time value there. These cash flow forecasts belong to all providers of cash flow if I'm looking at free cash flow to firm. So what I've got to do is I've got to compensate or risk adjust those cash flow forecasts by discounting them with a cost of capital that belongs to everybody, which is a weighted average cost of capital. Now, if I discount all of those cash flows that belong to everybody with a cost of capital that belongs to everybody, what I get back is a valuation that belongs to everybody, which is enterprise value. Now, ultimately, I may not be interested in enterprise value as my primary consideration, but maybe I'm interested in equity value. So I've got to go through this process of adjusting the enterprise value in order to bridge down to the equity value. And this is something I call the equity bridge. So I'm stripping out non-equity claims from that enterprise value. I'm capturing equity claims that are not captured by the main body of the valuation, and I'm putting through this adjusted process in order to get to an equity value which is a reflection of what I think the future could possibly hold. I'm going to run scenarios. I'm going to run base case, upside and downside, because I know if I just run a single scenario, those are a bunch of single point estimates that are undoubtedly wrong. I want to get an idea of what the distribution of the possible outcomes could be. And a very simple way of doing that is saying, right, I'm going to run a base case, an upside and a downside, and it gives me 3 points on the probability distribution curve of possible outcomes that could come out of this asset's cash flow generation into the future. Now, once I've done that, what I can start thinking about is understanding what that process is. It's going through from start to finish. It generates my enterprise value, my equity value. And once I've got that, I can then start thinking, okay, I have a little bit of an issue because a DCF produces a price that I think the company could generate, an equity value per share. Problem with equity value per share, it's not comparable. I can't take a $5 equity value per share and compare it to another company that has a $10 equity value per share and make comments on relative valuation and performance there. And that's why I need some multiples. So every DCF model that I run will generate multiples. Now, those multiples that I'm generating here are fundamental multiples or implied multiples. They're driven off what I think and a reflection of value. Essentially, what I'm doing is I'm going to be picking up the enterprise value, let's say, that's coming out of my model. So these are my thoughts getting to my enterprise value, and then I'm dividing it by a forward metric, whether that be revenue, EBIT, EBITDA, or NOPAT, an enterprise level metric divided into an enterprise level value. That gives me an EV multiple. Now, the nice thing about this is these multiples, they're relative. I can compare it to other companies. I can do benchmarking. I've got to be quite careful here and have the right lens on. We're going to talk about that in a second. But what a DCF gives you is the background story to multiple, because that's always been my fear, is that we talk about multiples, we talk about 15 times EBITDA, and we just run out of track in terms of the analysis. What I think a DCF does is it gives you the background story about where you think the company's multiples should trade. Because once I've linked it into my model, I can start talking about cash, risk, and growth. All right, because ultimately the metric, the EBITDA or the EBIT, is a function of revenue growth. It's a function of margins. It's a function of idiosyncratic risk. There is growth there. If I'm talking about growth, I want to talk about value creation or value destruction. So I will compare it to the weighted average cost of capital and the returns generated in this model. If you've seen any of the work on the platform, you know I'm obsessed with making sure that if we're talking about growth, we have context in terms of returns, cost of capital, value creation, and value destruction. If we've got a DCF as well, we're also able to talk about risk. Now, if you've got your model set up in this way, where the DCF is literally your background story and your framework, and if for whoever you're working for, their focus is on multiples and they want to know what the EBITDA multiple is, what you've now got is this ability to say, this is my story, this is my framework. I can talk to you about margins, growth rates, reinvestment, investment capex, maintenance capex, working capital management, inventory days, receivable days, payable days, because all of that information is embodied in the DCF that stands behind this fundamental multiple that you've built. But we've got to be quite careful here, because when we're looking at this, the other thing that we need to be thinking about is, okay, let's compare the fundamental multiple with other companies in the peer group. Now, if I do that, I've just got to be thinking about when I look at other multiples, maybe I've pulled a bunch of multiples from Bloomberg. Now, if I'm pulling those multiples from a data provider, those multiples are based on trading information. They're based on market information. They're not based on models. They're based on market capitalization. So just be very careful here. If you calculate multiples that are coming out of your DCF model and your work, you've got a fundamental multiple there. If you're then comparing it to where the company's trading on the market, those multiples are trading multiples. They are based on pricing. And try and compare the two together is useful because it'll give you an idea of relatively where you think the company stands in relation to its peer group. But when you're looking at the peer group, you are thinking about the pricing of those assets as opposed to the valuation of those assets. So having that clarity there is absolutely key when we're running through this process of trying to get back to what do we think the company is worth, compare it to where the company is trading or the peer group is trading. You've got to have that separation there. Now, the other thing I would certainly consider doing is using this model and running it in reverse. What I mean by this is essentially running what's priced in analysis. Now, you saw the arrows just kind of flip there. I'm going to go backwards again. That's our traditional approach to a DCF. We sit down, we forecast what we think is going to happen. We get to a valuation we think that asset's worth. Now, the flip side here, just watch the arrows, watch a little bit of the narrative here. So the arrows flick. You'll see the equity value at the bottom there is not equity value that's spat out by the model. It's the market capitalization of the business. So if the company is listed, we know what the answer is. So the reversal of these arrows essentially says, okay, we know what the answer is. Let's try and fit a narrative that into the model that justifies a scenario that could be plausible to justify what the market price is. What we're doing here is what's priced in analysis. Now, we can do that on a market cap basis. We could pick up the assets trading multiples and say, right, I know the company's trading on 15 times EBITDA. That equates to this level of enterprise value and market cap. Let me try and use the DCF to back out a story of what the market is implying in that particular multiple. And again, we've got a separation there, very clear in my head. What am I using this tool for? In this scenario, I'm using this tool to price the asset, not value the asset. And that is something that is super key with the work that we're actually trying to do here. So just to summarize, there are two things I want you to get clear here. One is, what are you using the DCF for? Are you using it to price an asset and you're running what's priced in analysis? Or are you using to value the asset and you're looking to kind of impute your view on what that asset's worth? And once you've got the difference between price and value, that's a great thing to have. Now, when you're looking at multiples, again, I'm going to kind of go up to what we had before. If I just reverse this a little bit, I want to make sure when you are looking at multiples, you're very clear on whether the multiple is based on your fundamental analysis or whether your multiple is based on how the company is trading. Because again, you're looking at two very different views, and it's very easy to get pricing and value kind of intermixed and confused in the work that you're doing. But that, I think, is an essential video to have very clear in your head. What I'm going to do in the next couple of videos is just show you how we can build these fundamental multiples into our model, and also have a look at how we can use a few tools to run what's priced in analysis as well. So next video, you're going to join me in a spreadsheet, very simple DCF, and we're going to build a story. See you soon.